it would look incredibly irresponsible if Google didn't do what it's doing
Yeah.
in terms of investing in AI and building itself up as a very credible, I suppose, competitor. It shouldn't be really a competitor to OpenAI, but I guess so in the terms of like that breakneck speed of development. But it is all built up right now. And honestly, the ROI, I don't know if it seems to be exactly there yet, is it? Hi there, and welcome to Stock Club, a podcast brought to you by MyWallSt. I'm Mike, and joining me today is MyWallSt analyst Anne-Marie Kingsland. Before we get into today's show, we have an exclusive offer to our loyal listeners here at Stock Club. So with the code StockClub20, you get 20% off across our entire product line here at MyWallSt. That means 20% off Invest or Invest Plus, where you receive our weekly Charging and Fearless newsletter, 10 starter foundation stocks, and our market beating stock of the month report. You get 20% off Horizon, our exclusive service where you can invest side by side with our chief investor, Emmet Savage, or 20% off Nexus, our international service dedicated to uncovering hidden gems from around the world, which is currently outpacing the market and returning over 30% on average since its inception. So you don't want to miss that one. So whatever you are in the market for, we've got you covered with the code StockClub20 at checkout. Now, let's get into the show. Anne-Marie, how are you?
I'm good. How are you?
I'm good. Welcome back to Stock Club. It's been a while. Emmett's off
I
on his
know.
hollybops.
I know. That's the only time I get called up is when somebody's on a long vacation.
You're super sub. You're the Ole Gunnar Solskjaer of finance podcasting.
Sure, I'll pretend
Yeah.
like I understood that reference.
The real bemused look you gave me for a second as well.
Uh-huh. Yeah, good.
Okay, so we're getting into the show. We're kind of just basically we picked the best stories we could find from earnings over the last couple of weeks.
Yeah.
Yeah, we talk about earnings a lot. Sometimes we shouldn't bother. Do you know, like, as in they're not as
Yeah.
important as probably people give credence to, but there was some big stories to come out. My favorite one was the CEO of LVMH saying champagne sales are down because there's no more joy left in the world. Was that his quote?
Yes, I believe his exact words were maybe read this in a French accent as well. You know the way they deliver things. He'd be like, maybe the current global situation, be it geopolitical or macroeconomic, doesn't lead people to cheer up and open bottles of champagne. I don't really know.
I don't really know. It's great at the end.
Yeah.
It's like, what's going wrong? Why are your sales down? He's like, maybe you're sad. I don't know.
He's like, maybe people don't want to drink champagne. I don't, it's not my issue. I'm drinking champagne.
Yeah,
So,
I'm not the problem. It's all of you
yeah,
sad
you are the
effers.
problem. Yeah. But then to be fair, he does redeem himself later on in the quote, and he does say that there is severe pressure, particularly in Europe, and wine and alcohol sales across the board are actually down. So he
Yeah,
does redeem himself a little bit, but he did go very hard in with everyone should only drink champagne when they're celebrating. There's nothing to celebrate.
everyone is just a little sad boy. Yeah,
Yeah.
me and Emmett talked a few weeks back about how alcohol sales in general are suffering, especially beer, and it just
Yep.
comes from especially Gen Z. Gen Z are they're of the Gen Z and adults like above 21 in America will say
Hmm.
they are the cohort that drinks the least of any
Yeah.
kind of age group, which I thought was
Yeah.
nuts because even back in the day, that age group, like say 21 to 25 would be the people that drink the most usually like.
Yeah, and actually that's interesting because I saw a graph yesterday that was discussing, like kids who are labeled as straight edge, which means they don't drink any alcohol, they've never taken any drugs, any of that stuff. And it was something like back in 1975, it was less than 10% of high school students in America graduated were considered straight edge. And they retook the survey this year, and it was like 40% of students were graduating high school having never drank any alcohol. So I do think it's like a fully generational trend of kids just being like, "Oh, I'm not that interested." And then, as you said on that last podcast, if they miss that window to get people to start drinking, they kind of never do. Then I think if you don't go through the college years of like getting used to alcohol and then kind of graduating to a place where you're like drinking it not in a way that's threatening to others, um, that's like
Threateningly drinking.
yeah, if you don't graduate to there by the time you're about 25 or 26, I don't think it's going to happen. Like you won't be like, "Oh, I'll have a glass of wine at dinner." You'll just be like, "Oh, I won't bother." So they got to get it. I don't know what they're going to do, but they got to get something has to happen.
Yeah, and it's a big waste of autonomous driving if no one is drinking anyways.
Mm.
That is a 30, 40
Closed it
year
down.
40 years down the road. Okay,
Yeah.
but let's talk LVMH anyways while we're on the subject. So
Yeah.
they were suffering, like basically all luxury companies, from a weak Chinese economy. Is that correct?
Yeah, that's kind of the big selling point that we had. And on top of the alcohol issue, just a reminder for the listeners, LVMH is Louis Vuitton, Moet, Hennessy, but they own like 75 big luxury brands, and that's everything from leather goods to jewelry to perfume to alcohol. So, they're kind of exposed to everything, which is great in some ways because if leather goods fall out of favor, they can say, oh, we'll make a bunch off the Dior perfumes. But it's also bad because obviously if the entire sector has a massive drop, it'll have a big impact. So for the half year that we just finished, revenue was up only 1%, bringing in $20.98 billion, which was below estimates of about 3% growth. But most importantly, it saw a 14% drop in net profit, only bringing in $7.27 billion. The main concern here is sales in Asia, excluding Japan, which is obviously dominated by the Chinese market, fell 14%, which was exacerbating concerns that we kind of already had that luxury demand in the world's second largest economy was beginning to falter. However, there is a caveat to this, which, as we all know, there's been those headlines the last 6-ish months that Japan is going through an economic hardship and that their currency has dropped. And it seems that a number of Chinese people are beginning to actually save their money, go to Japan and buy luxury goods there because the currency exchange is so favorable, they save a bunch of money. So that was kind of the saving grace that LVMH tried to write this off as. They were like, yes, spending in China is dropping, but the money is moving elsewhere in the region. And there does seem to be a decline in overall spend, but it's not as bad as this 13% is kind of letting on. So that's all right, I suppose. Something that we maybe need to discuss that's more long-term other than this result is that there is a generational shift happening here in terms of luxury spending. And I think LVMH is kind of at a bit of a crossroads trying to decide what to do about it. There's a group that the Boston Consulting Group has labeled as aspirational luxury consumers. And these are people that are not traditional luxury buyers. And they've emerged more like with millennials and Gen Z because they spend more than any generation before on luxury, but it's not broken out the way you'd expect. It's not like, oh, all these people in the upper classes are spending like crazy and buying all this stuff. It's people in the standard middle classes once a year splurge and buy an LVMH handbag or something like that. And the issue there becomes if Louis Vuitton makes 60% of its revenue from aspirational shoppers, people who are basically buying above their economic stature, does that mean that they should release more products that that group can afford but risk diluting the brand by doing so? Because so much of the reason that like Louis Vuitton is so desirable is because you say, oh, rich people use this, rich people have these bags. And so that seems to be the kind of crossroad that LVMH is at right now, trying to figure out, okay, should we be appealing to more people to make us more stable rather than just kind of chasing rich people and catching a couple middle class people by accident? And it was actually an argument that Boston Consulting Group was discussing in relation to LVMH was like a huge sponsor of the Paris Olympics, and they were featured prominently in the opening ceremonies. They actually made the Olympic medals, and they made the boxes that the Olympic medals come in. They made the Olympic torches this year. That was a big thing. And it's estimated that the marketing that they're getting from that is worth about $165 million. And part of the main argument for why they would go so hard for this is it's a great opportunity for them to get the brand in front of everybody, not just people who are traditional luxury shoppers. And so people are wondering in the next 5 years, is LVMH trying to turn just a little bit to capture more of the middle class in favor of just like making more money long term? So that is what I would like to hear your thoughts on. Do you think that's worthwhile?
It sounds very risky for, well, it depends because it's certain brands. You know what I mean?
Yeah,
LVMH
yeah, yeah.
oversees hundreds of brands. But if you're talking about, say, Louis
Yeah,
Vuitton, I assume from the Olympics, because they did the same with the
yeah,
Rugby World Cup. Do you remember? You probably don't. The World Cup was in a Louis Vuitton suitcase. They
yeah,
bring it out and unveil it and all the rest. I assume it's the same with the Olympics or something similar.
yeah,
Um, yeah, like we talked, the classic luxury strategy is managing scarcity to a point where
yeah,
you maintain brand value while also ensuring that the company still makes money. I think Ferrari have
yeah.
done this really well, where Ferrari are really strict on they have a certain number of cars they want to release
Mm-hmm.
every year, and there is waiting lists and all the rest. And Louis Vuitton, you're talking about aspirational stuff, and I think aspirational is a good way of looking at it because Morgan Housel talked about this in terms of how people interact with other people in terms of comparing themselves. So
Mm,
you traditionally in say the 50s and 60s, everyone would live say on the same street and the rich person would just have a slightly bigger house and a slightly bigger car. And that's the
yeah,
person you would see every day and that's the person you would compare yourself with. And it was close enough that it didn't really make a huge difference. But now in 2024, the people we compare ourselves with are on social media. So
yeah.
you're not comparing yourself to someone who lives on the same street. You're comparing yourself to millionaires, billionaires, heiresses, all the rest. And that's where that aspirational thing comes from. So I think I danced around your question quite a bit. I don't like a luxury company going for more mass market in general. I think that's the
Yeah,
beginning of the end for a lot of them.
yeah.
Um, does Louis Vuitton realize like as in I don't think Louis Vuitton realizing it has mass market appeal is a bad thing.
Yeah.
But do you just accept that you're only going to get a certain section of that, the people who are motivated enough to really make it like a one-time buy every few
Yeah.
years or whatever else it is? So, yeah, in general, the luxury strategy is very defined. I wouldn't try to alter it too much, but they know a lot
Hmm.
more about it than me in LVMH, so I don't know.
Yeah, I suppose I wonder, are they sitting inside going, should we make more keychains? Because I do think ends up
Something
being what
like
people
that. Yeah, yeah,
buy.
yeah.
Yeah, because you think if people go on vacation to Paris and they go to Champs-Élysées and they see all the stores and they do have that thing of they're like, I want to buy something in this store, even if it's ridiculously overpriced and it's not reasonable. I think they just want to have something that's been stamped and marked by coming from Louis Vuitton in Paris. But what's actually interesting about the scarcity mindset when it comes to luxury, like nowhere is that more present than Hermes. Hermes, the Birkin bag, you have to get on
Yes,
a
we
waiting
talked
list for
about
that.
Hermes a while back as well. Yeah, I kept
Yeah,
calling it Hermes, and they gave me shit on social media about
on
it.
social media because all the all the Hermes experts on social media,
Hermes.
yeah. Yeah. But what's interesting, they actually just reported yesterday and they said they had a 13% rise in sales in the same period, 17.9% growth in the company's largest division, which is leather goods, which that would be the Birkin bag. Interestingly, sales in Asia for them, excluding Japan, grew 5.5% during the quarter. So obviously some of the Chinese market is
Mm.
remaining in China to buy bags.
Yeah,
I
so maybe it's
wonder,
a Louis Vuitton problem, not a China problem.
there you go. But I actually do wonder, is this a reflection of the sales process? Because to get a Birkin bag, you got to get on a wait list like 2 years in advance.
There's,
And that wait list is for your store. So
yeah.
is it like they got on the wait list 2 years ago and they're like, oh, I should have gotten on the wait list in Japan. Like, why did I do this? Um, but something that was interesting was their CEO, who's Alex Dumois, added that Chinese clients are currently looking for high quality products, but not necessarily with logos, which they said was a change that will benefit Hermes because Hermes is not one for the flashy logos. It's not Louis Vuitton with the LV on all the leather. And this is consistent with industry trends seen last month. Preferences are shifting in favor of more discreet fashion as the wealthy don't want to flaunt their wealth in a time of economic austerity. That's very good of them, don't you think? Hermes also noted there was lessening traction among aspirational customers because the way they measure that is through their silks and textiles, which Hermes makes scarves. That's like their fancy thing. That's their equivalent of the Louis Vuitton keychain. People go in, be like, oh, I
Yeah.
really want to own something from Hermes. I'll get a scarf. Um,
Or not
so
only that,
scarves,
they'd be like, how do I get in good with this shop? How will they let me buy a bag
yeah.
eventually or buy a bunch of scarves kind of thing?
Yeah, scarf sales down 5.6%. So obviously, those aspirational customers, they're hurting.
Yeah.
Um, but the billionaires are doing fine. So that's
Yeah.
great. So yeah. So I this is the thing for LVMH is it's kind of like, okay, you're at a bit of a crossroads. The companies above you are doing fine. What are you going to do here? And I suppose something that you said is interesting is they control 75 brands. So they could, in theory, say, okay, Louis Vuitton is their largest brand. They could say, okay, we're going to allow Louis Vuitton to make some slightly cheaper products to appeal to a mass market, but then we will preserve the remaining brands and they will remain high tier. That could be maybe where they're going, but it's definitely something to watch. I'm definitely not opposed to LVMH as a stock right now. They're still the second largest company in Europe and they pay a massive dividend. So I feel like if you're trying to shore up with some kind of consumer good in your portfolio, I don't hate them, but well, I'll definitely be watching them the next couple quarters.
Okay. Okay. Sounds good. Moving on, then we're not going to go through Google's earnings report because it wasn't that interesting, really.
It
But
was kind of fine.
yeah, it's fine. I think YouTube was a bit shaky, but that was it. But there was one theme that, and we're recording this a bit early in the week, so we're missing out on Microsoft and Facebook's earnings, which are going to be live by the time this episode goes out.
No.
But it's going to be a predictable theme is that investors are basically looking for ROI on AI spending. So
Yeah.
Google, Microsoft, Facebook, Tesla, Amazon, they're spending billions and billions and billions and more CapEx every quarter just on AI build out alone, essentially buying
Mhm.
NVIDIA chips pretty much. So you looked into this a bit. What do you think is kind of the main theme coming from this? Because I thought Sundar Pichai's comments were quite interesting. He kind of said,
Mm.
if we like, the risk of not doing it is a lot worse than the risk of doing it.
Yeah, what was his? I have his exact quote here somewhere. Yeah, he said the risk of underinvesting in AI was greater than the risk of overinvesting in AI, was basically his argument. And I suppose when you generate a lot of money from search, I understand that. I understand that you probably feel the pressure of ChatGPT breathing down your neck. You're like, oh my gosh, if like most simple searches can be written off with our competitor, like what will that do for our advertisement? I understand the panic is on. But I actually think we probably could have predicted that there was going to be somewhat of a Google sell off because of the Goldman Sachs report that came out, I don't know, a week or two prior to it. It was a 31-page report. It was entitled Gen AI, Too Much Spend, Too Little Benefit. And this was basically, I suppose we could call it like the canary in the coal mine for AI spending. We were really in a hype cycle, NVIDIA is being pushed up, all the big tech companies being pushed up. And then one person went, guys, like, when are we going to make profit off this? Like, what's our horizon here? What's our deadline? What's the 10-year outlook going to be? And so Goldman kind of took this long view and talked to a bunch of economic experts. The most interesting one that kind of I came across within the report is an economist called Darren Acemoglu. Hopefully I pronounced that right. He's out of MIT and he works on a team there that basically just focuses on like the future of work and the future of productivity. So he does a lot of work around AI. And he's pretty negative on AI, but the AI simply on the AI that exists right now. So his big criticism is on large language models,
Yeah.
where he's basically like, I don't understand why we're all so hyped on large language models. We should be focused on more nuanced AI tools developed specifically for certain industries that could benefit from them. So his argument was, right now we seem really focused on automation, which is the idea of replacing a person, where he thinks more productivity benefit actually comes from augmentation, which is providing people with tools which will make them more productive. So his whole thing was, I think we live in an age where there's a real drought of reliable information, and he doesn't really ever see that being solved by a large language model, because the pace that we're at right now, we're going to run out of data in 4 years to feed these things. And he was like, there's no way that we're going to be able to get to an accuracy point where you could reliably go to a Google or a ChatGPT and type into their AI a question and for sure be like, yep, nailed it. That's 100% accurate. I have faith in that. And so his thing was like, I wish that more AI spending was going towards something that was mathematical, statistical, and data driven. The idea he gave was using it more for financial data verification. So, for example, when you apply for a mortgage, obviously all your bank accounts, everything has to be verified before the bank will approve the mortgage. He was like, that's a great AI opportunity where it can just be connecting dots and running predictions and that sort of thing. And I kind of agree with him, because I do feel like we work in a space where we are writing a lot of the time and we're trying to, disseminate information to people. And the ability for us to use AI really only helps when we're adapting stuff that we have already written and we have verified and we know is factual. And so I would never go to ChatGPT and be like, give me an analysis of a stock, because I wouldn't trust it to be able to do the qualitative side of things. And so I think that that's the doubts that people have kind of now sown into the Google stock. Is it came out in the report that their burn rate for AI was 13 billion this quarter. So they spent $13 billion this quarter. And like, that's a lot of money. And that
Yeah.
reminds me a lot of when it came out, when Meta was like, oh yeah, we're spending X billion on the metaverse like 2 years
So
ago. And all
exactly
of a
what I
sudden
was thinking. Yeah. I think
everybody just went, oh,
this was from Q1. It was Amazon, Microsoft, Facebook, and Google combined had a total capex of 44 billion. And each
yeah,
each call included like a promise from CEO, we are stepping up our investment in AI.
yeah,
Yeah, and like Zuckerberg is a perfect example of that, where he got attached to this idea because the metaverse seemed like a threat to social media.
mm-hmm,
You got attached to this idea, like, well, we have all the resources, of course, we need to back it and we need to be the one. And Google
yeah,
is kind of doing the same, because we see ChatGPT and we see it give answers that seem right. Sometimes they're not. And now OpenAI has said it's committed to bringing out a search engine as well. It would look incredibly irresponsible if Google didn't do what it's doing
Yeah.
in terms of investing in AI and building itself up as a very credible, I suppose, competitor. It shouldn't be really a competitor to OpenAI, but I guess so in the terms of like that breakneck speed of development. But it is all built up right now. And honestly, the ROI, I don't know if it seems to be exactly there yet, is it?
No.
And
No,
and,
not in.
and not even that it's not there yet, but even the way people are going about it in terms of OpenAI isn't charging much. Facebook just
Mhm.
released its Llama 3.1. Its most
Yeah.
recent LLM anyways for free. Do you know what I mean? It spent 9 billion developing it. 9 billion on processing power alone developing it, not to mention all the
Yeah.
other costs involved. So it does just seem like an absolute capex rally.
Yeah.
Where the money comes out at the end, I'm not sure.
Yeah. It was interesting when I was reading the report from Goldman, and they were discussing, oh, we have a drought of reliable information. I was like, I bet you Google would probably get more benefit by adjusting, because how everyone's complaining the search algorithm at Google has gotten really annoying. That's why people put Reddit at the end of everything, because it's
Yeah.
all SEO garbage. They would probably get more benefit out of working to fix the algorithm, to get the algorithm better, and then working with the AI stuff in the background. Because when they pushed out the AI sample and it started telling people to put glue on pizza, the way that has probably eroded public trust in Google's AI and Google just in general is horrible. You probably are doing more favors to preserve investor capital by not rushing into AI and being a bit more conservative and being like, okay, we are working on this, but this is a long-term plan for us and blah, blah, blah. Yeah, I mean, I think there's going to be a massive correction. I think we're going to go into a tech correction here. I think we're already approaching it. I think we're in it. Yeah, so buy LVMH. There's no
Hmm.
AI there.
Yeah, well, look, the reality is we can be in a bubble and AI can still be this like, life-changing technology. The internet, the
Yeah,
dot-com bubble was very real, but we're on the internet right now. It's a big part of everybody's lives. And it's a good example. It's a good kind of, I suppose, pathway which we could follow because
yeah,
we're talking about how AI could be so disruptive to the jobs that exist now. I think that we're going on another positive slant here from, I assume, a different section of Goldman Sachs. But
mm,
they're arguing that AI will automate 25% of all work tasks in the US.
yeah,
Now, that sounds very doom and gloom, but it also means that's going to create a load of new jobs as well.
yeah.
Think about how many new jobs there are compared to 24 years ago. Think of all your jobs your friends have. Did any of
Mm,
them exist in 1999?
yeah, no.
Do you know what I mean? Like, so
Yeah.
it's easy to just see the immediate threat without seeing the immediate opportunity. And
Hmm.
I'm not saying that it isn't a bubble. It probably is. The spending is out of control, but I still think overall it will have a positive impact. And
Yeah.
I think it could be as impactful as the internet. But again, it probably needs to be seen as a bit more functional. Is that like as in
Yeah.
for the consumer side at least?
Yeah. And even like Goldman itself, they were describing, they developed an in-house AI for themselves to update historical data for its company models. And it said, yeah, that's a great data task. We'll get an AI to do that. And they built it. And it effectively, that took a task out of probably an intern who had to do that's hands, but it cost them 6 times as much to develop the AI as it would to be to pay the intern. But think of the long term. That's great. In 6 years, that will have paid for itself. And it means somebody doesn't have to sit there and plug in data all day.
Yeah. But
So like
but
that's the kind of stuff I'm thinking of. We need to be.
yeah. Klarna said it's cut a bunch of jobs and has made loads of savings from AI.
Yeah.
Now Klarna were probably going to cut jobs anyways.
Yeah.
But Jamie Dimon as well, he's saying they're using their internal AI models across nearly all facets of the business. So it's easy to be caught on this hype cycle on the way up. And then once it's
Yeah.
questioned, be like, oh, it's so obviously correct as well. When probably every single time we're always going to be in the middle area in some shape or form. It's never going to be
Mhm.
black and white. So yeah,
Yeah.
it will be interesting. Obviously, we're going to hear people listen to this will have seen Microsoft and Facebook's results as well, there probably will be a similar focus on getting some form of ROI out of all the spending. But
Yeah.
in general, yeah, look, like it's not surprising to see a correction in the Nasdaq as well. I think it was on like a 60% run over the last
Yeah.
year, something nuts. So yeah, we'll see. We'll see what happens. But it wouldn't be surprising to see the AI hype dampen because it probably needed to.
Yeah, oh, definitely. Like even the S&P 500 concentration, like we all know that that's not good. There should not be 7 stocks driving the entirety of the market because
No,
everything else did
just
get left behind.
Nvidia alone driving about 20% of the market's gains, that's not
Yeah,
sustainable.
no, but I suppose it's a good time now if for investors who are looking for anything other than the 7 magnificent stocks driving the market, now I think the market is probably going to start looking at stocks that we've been talking about, smaller cap stocks, and be like, oh yeah, there is still value to be had in something other than Google or Apple.
Yeah. I'll tell you one stock they won't be looking at. Dexcom.
Oh no.
Had a
Oh,
brutal day last Friday. So they reported last Thursday night.
yeah.
And Friday, the stock fell 40% in one day, which I think has got to be the most extreme story coming out of this earnings season so far. For those who don't know, Dexcom is a leader in constant glucose monitoring devices for diabetes
Mm-hmm.
care. Basically, you've probably seen them on your mates or just even in public. They're the little yokes you see people wear on the back of their arm.
Yeah.
Um, and it takes glucose measure, blood sugar measure every 5 minutes or whatever else. And it
Mm-hmm.
basically has revolutionized how people treat diabetes. It's made it a much more manageable disease for a lot of people.
Yeah.
It's a company actually my fellow Galwegians will know a lot about too. It sponsors Connacht Rugby and it's putting in a 300 million euro site out in Athenry. But yeah,
Wow.
we're talking about it today for not so good reasons.
Yeah.
Basically how the stock nearly got cut in half in one day. So, what happened? Revenue, it only missed revenue slightly in actually Q2, but it's
Mm-hmm.
what happens next, basically. And it really comes down to guidance. For Q3, it expects revenue of 975 million to 1 billion, which would be a dip quarter over quarter and well below kind of how it shakes out in terms of full year revenue. And then it updated full year fiscal guidance. It now expects revenue of 4 billion to 4.05 billion, down from 4.2 to 4.35 billion. So at the widest point, that's a 300 million revenue drop. And this was revenue guidance given last quarter as well. So in the space of 12 weeks, it's basically seen 300 million quid disappear from its bottom line over the course of the year. Uh, Reasons from management were a bit shaky, kind of all over the place, which probably exacerbated things a bit. So CEO Kevin Sayer cited a restructuring of its sales team, fewer new customers than expected, and lower revenue per user. The sales team stuff just sounds a bit messy.
Mm-hmm.
Basically, they moved staff around, they cut jobs, and apparently with the restructuring, they lost coverage in certain areas, and doctors were dealing with completely new salespeople. There was no relationship formed there, and it caused a bunch of issues. Um, it's also getting hit with a bunch of rebates for its new G7 device, which is adding to this kind of perfect storm and bringing down the lower revenue per user as well. But yeah, it's tough looking at this and not immediately diagnosing it as, oh, this company was really, really expensive. And this is what happened when really expensive stocks go wrong, essentially.
Yeah. Yeah.
Me and you, we looked at the stock a bunch of times at MyWallSt. It
Yeah.
was always too expensive. I think I was looking over your notes when you first wrote them. Was it 2021, 2022?
Yeah. Yeah.
Yeah, it was at 25 times revenue at that point, which is just outrageous. There isn't there isn't a software company on the market going for
No.
that right now. So yeah, from those heights, it's just a long, long way down. And when you go through a quarter like this where everything goes wrong, it really, really hurts you. So that's the risk of owning these very expensive stocks. They could be a wonderful business. They could be doing everything right, but one hiccup, one shake, and it comes down very fast.
Yeah, I wonder if this kind of narratively being impacted as well, probably by like the semaglutide thing, and people are all of a sudden like, oh my gosh, no one will ever be diabetic again movement, and kind of compounding that sell off. Like 40% is pretty significant for just a revenue blip.
Yeah. I mean, this was
Oof.
actually brought up on the call, and
Mm,
there's definitely that undercurrent that a lot of
yeah.
people might be putting it down to as the rise of
Yeah.
Ozempic and GLP-1s. There's been the kind of cohort of stocks that would be affected by Ozempic, and these drugs started as diabetes treatments. I
Yeah.
know I know they're the main ones now are just weight loss drugs. They're not actually diabetes treatments anymore, but obviously for type 2 diabetes, I'm talking about here, poor diet and being overweight are big factors in people developing this disease.
Yeah.
And Dexcom has basically outlined that its opportunity lies in tackling people that have type 2 diabetes. Right now, it's
Mm,
predominantly based in the type 1 market, but the type
yeah.
2 is so much bigger, and it's basically outlined it as this is where we're going to really get our growth from in the coming decades. If you
Yeah.
have these drugs that are becoming increasingly popular that are reducing the risk of that, obviously that's going to be a big narrative around the stock. However, they addressed it in the earnings report, and it was debunked a small bit by the numbers. So new users with type 2 diabetes actually accelerated in the quarter. It was one of the few things that did accelerate.
Oof.
And Dexcom and Abbott have come out and said that patients with type 2 diabetes on GLP-1s are actually using constant glucose monitoring devices more consistently than those who aren't.
Hmm.
So
Okay.
it does make sense that this is, one of those stocks really bent over by Ozempic and the rest of the GLP-1s. But I think there's an argument against it too. It just immediately, that's where your mind goes. But I think there might be more to it. So yeah, a messy quarter. But I don't think Ozempic is the big reason why.
Yeah. Do you have any desire to go digging around there for a stock of the month or anything?
I thought about it, and then I saw the earnings report, and that was like, I'm not bolshy enough to recommend a stock a week after it drops 40%.
Yeah.
I
Yeah.
need to know way more about it than why it's get cut in half after one day. So yeah.
Fair. All right, then. So we're going from CGM's constant glucose monitors to CMG Chipotle Mexican Grill. Perfect segue.
That was nice. I thought you were going to go from
Yeah.
Ozempic to burritos with that, but that was better.
No, no. And we didn't even plan that. I realized that like 15 minutes ago. I was like, oh,
That's
yes. Okay.
talent.
Yeah, thank you. Okay, so I mean, listen, Dexcom had a terrible quarter. You know who had a great quarter? Chipotle Mexican Grill. Unreal quarter. So revenue was up 18.2% year over year. Nuts. Same store transaction growth up 8.7%. Same store average check up 2.4%. Digital sales now represent 35% of total revenue. And their operating income jumped to 19.7% of sales. That's pretty good. And the
Mm.
reason that operating income is up and its margins are up is because of those digital sales. It's allowing them to open Chipotle lanes, which are basically outlets that all they do is carry
Just
out. It's essentially
pre-order,
just
yeah.
yeah, just drive-throughs. So you can't even, there's nowhere to sit, and it allows them to just be very efficient in terms of real estate. They opened 52 new restaurants this quarter, and 46 of them were Chipotle. So this is obviously something that they're loving and doing more of. That brings total restaurant count up to 3,479. That's a lot of Chipotles. Company has importantly, this is the most important part, was we had all those social media reports over the last couple months. It said
Yeah.
Chipotle is doing small scoops. They're shortchanging us. And so the company in their call denied reducing its portions. But the CEO did say, we have focused in on those with outlier portion scores based on consumer surveys. And we are re-emphasizing training and coaching around ensuring we are consistently making bowls and burritos correctly. He then went on to tell analysts, we have also leaned in and re-emphasized generous portions across all of our restaurants, as it is the core brand of Chipotle. So
That
there you
was
go, folks.
that was a low point, I think, in internet history where people were just shoving their
Filming.
phones in poor Chipotle workers' faces, being like, make me a
Yeah.
big one.
Yeah. They're like, I will report you, worker
Yeah.
making $15 an
This is
hour.
going to your boss, minimum wage worker.
Yeah.
It was
Yeah. I
awful.
want to substantial quantity of beans and rice.
Yeah,
Um,
or literally like half a scoop more beans. Like,
yeah, like the chicken, it has to be measured. Like they're not giving you extra chicken. All you're gonna get is like an even larger helping of sour cream. And like you don't want that much sour cream. Come on, guys. Okay. But on top of all of that, we're getting extra scoops, but also we're getting a $400 million stock buyback. Great news, everyone. Overall, like absolutely blown away by this result. It's so crazy to me that you could like continue to be growing at this level with the company at the age that it is. And the one thing I keep coming back to is Chipotle has no significant international expansion. This is growing
mm,
entirely in the United States.
that's what I
And
was
they've
thinking
got
as well. They never even bother, do they? They don't need to.
no, no, and they have 3,500 units. They want to get that to 7,000 within the next 10 years. So we're going to have growth at home. And then there's still that opportunity probably in the back of their minds going, hey, do you know what? We could probably open some stores in the UK. Like as of right now, they've got 2 outlets in London, 1 in Paris. And the big news that they put out 2 months ago was that they were going to start testing in the Middle East and they're opening 1 store in Kuwait. That's it.
That's it.
Everything else is just US based. So I'm kind of loving it because you're saying, okay, they've got the sustainable growth at home. Obviously, the brand is high in people's minds at the minute because we're seeing the increase in ticket sizes and increase in same store sales, which means people are coming back, they're spending more. Love to see it. That's great because they actually raised prices about 6 months ago on the guacamole and a few other things. So to be able to do that and still have sales going up is really nice to see. And yeah, just imagine management being like, okay, guys, we're going to open 3,500 extra stores in the US, but also we haven't even tapped Europe yet. And Chipotle has such
Yeah.
brand recognition online, they probably could open in Europe and be incredibly popular. So I loved it. It was a great quarter. I mean, obviously the thing is now we're reporting being like, this company is wonderful. Where's the P to E? Because, maybe you want to take a little nibble.
Hmm.
48.
Yeah. Yeah.
P to E at 48. It's pretty high. But it is still lower than it was during the 2020 pandemic stock rush. So that's not too bad. And it is lower than it was a couple months ago. It was touching 60 about 4 months ago.
Yeah.
So
Chipotle is just one of those businesses, you know. Bill Mann always tells a story when he's talking about discounted cash flow models and looking at
yeah.
comps and all the rest. And he's like, if I went into any business school in the country and I told them that I have this burrito chain that's going to
Mhm.
compound revenue at 20% a year for the next 30 years, they'd
I'd be
laugh
like, no
me,
way.
they'd laugh me out of the school and I get an F.
Yeah.
And
Yeah.
this is that business. And there's so many, we talk about the Peter Lynch method of finding stocks by looking at around you, looking at the companies you use. Chipotle
Mhm.
is absolutely one of them. I'm sure of it that it has made a lot of people a lot of money just from the fact that, oh, I like this burrito. Can
Yeah.
I, what does the business do? Do you know what I mean? Can I invest in this
Yeah.
business? So yeah, it's one of those businesses that keeps chugging away. I think its popularity probably increased through all that portion size mess because
Yeah.
it went viral, first of all. It probably would. No, I won't. Definitely not when it comes to a restaurant. All publicity is not good publicity because Chipotle, of all things, had that E. coli thing in
Yeah.
2017,
2015. Oh,
2015. And that was all over the news, and that was not good publicity. But in general, it just doesn't slow down. It's a beast, and it's probably the most expensive restaurant stock in the market, if not one of them, anyways.
yeah.
And maybe it deserves it. Do you know what I mean? Like, as in,
Yeah.
if it's been able to deliver results consistently for this long, why not have a ridiculously expensive
Mhm.
valuation on it? I don't know. So yeah.
Yeah. I would also say they responded quite well last year when there was labor, when people started talking about labor and getting paid more. Like I feel like Chipotle came out well against that. And they were like, okay, we're going to raise everybody's minimum wage $15. We're going to look at college subsidies. We're going to look at health insurance. And
Yeah.
then, and they
Because
still are
it's because they
delivering.
can operate a full restaurant of people with like 3
Yeah.
employees. Do you know what I
Yeah.
mean? It's such a simple process. Like,
Yeah. It
yeah.
is it's brilliant. But yeah, I was very impressed. I was very happy to see it. I was actually thinking though when I was looking at this high PDE and you were talking about Dexcom and it was like, oh, this is a stock that had incredibly high expectations and it had one bad quarter and the whole thing came crashing down. That is really what happened to Chipotle in 2015. If you remember, like when they had that E. coli or Listeria outbreak, that stock tanked. That thing, it fell like 50%. And it really only came back like fully recovered from 2015, like 2 or 3 years ago. So that would be maybe my only concern with Chipotle is like expectations are high. People are expecting this growth to be delivered. If they have a slowdown, I would expect it to sell off, probably more than it should. So yeah. but
Yeah.
great quarter.
Okay. Last one for today. So Chipotle, I only realized this connection when you sent me over your notes. So Chipotle is one of Bill Ackman's highest, biggest holdings in Pershing Square. So is Universal
Mm.
Music Group, or UMG.
UMG.
And that had a rough week of it as well. So I got all the bad news, basically. I was looking at
Yeah.
Dexcom and UMG. But UMG is, if you don't know it, it's the world's largest music label. It's actually one third of the big three, which
Yeah.
are three music labels that essentially own the rights to every major recording artist. They kind of have a stranglehold of the industry. But UMG in particular for this, the other ones are Sony and Warner Brothers, not Warner Brothers, but Warner Music.
Warner
Is that
Music.
correct?
Yeah. Spun
Yeah.
off. Yeah. Yeah.
Yeah. So UMG represents Taylor Swift, Drake, and Kendrick Lamar, which I found interesting. The Beatles, Adele, Lady Gaga, loads more. So yeah, what happened with earnings? It had its worst day in history. So Dexcom had its worst day in history, and UMG had its worst day in history. I'm bringing you all the bad news today. Last Thursday, it fell by up to 30% on the day. I think it closed about 25% down, maybe a bit more. Similar to Dexcom, it wasn't really the quarter itself, but it was the shock of the decline that caught investors off guard. So subscription revenue decelerated big time. It's still growing, but at a much slower clip than was expected. So it went from 12.5% growth in Q1 to 6.9% growth in Q2. Some of this is attributed to lower ad revenue from Spotify and YouTube. Amazon Music and Apple Music underperformed, and they put in a price increase as well, which is messing with a lot of things. But probably the biggest effect on revenue alone was in social media. So short form video, for better or worse, now is one of the main distribution channels for all of music, basically. We've seen it with TikTok. TikTok has created some of the biggest music people out there today. I don't think you've
Yeah.
got who Jack Harlow doesn't exist without TikTok in like
Olivia,
three.
Olivia, Olivia
Olivia
Rodrigo.
Rodrigo. Yeah, like, you know,
Yeah.
with like three very buzzy 30-minute clip, 30-second clips that have just created careers. So
Mhm.
TikTok and Facebook now have basically huge influence on the music industry in general. So starting with TikTok, this was well reported back in the day. UMG and TikTok had a big standoff for about 4 months. It was about between February and May, was it?
Yeah.
Yeah, where UMG just pulled all their music off the platform. And it did it. It's funny because you're looking at UMG as these like knight in shining armor representing all these artists and getting them
Yeah.
better deals, and you know, TikTok
Yeah.
doesn't pay us enough and whatever else, where music labels in general are like the big bad of every biopic movie you've ever seen and
Yeah.
treat artists like awfully. But
Yeah.
you know, when they renegotiate better deals for artists, it means they get a better cut as well. The
Yeah.
artists are still making F all. Do you know what I mean?
Yeah. Yeah.
But
Yeah.
they reached an agreement in May, which meant better pay for musicians, better royalties, and I think like kind of agreements around the use of AI and stuff.
Yeah.
But that meant that for a third of this quarter, it missed out on all the revenue from TikTok for 1 month. It's now having issues with Facebook as well. Facebook used to offer premium music videos to all its users, but they basically said no one really likes this, so we're not paying for it anymore. That also caused a drop in revenue coming in for UMG. So those are the big two that hit its revenue in general. But if you actually look at the quarter as a whole,
Mhm.
I don't know, it doesn't feel like it deserves the kind of dip it got. Does it? It
Yeah.
doesn't feel like it was the worst day ever after looking at these results. So overall revenues are up 10%. They beat expectations. Adjusted EBITDA grew 11%. It bet expectations as well. And then net profit soared 46%. So it was up at nearly 1 billion euros. So
Hmm.
I don't know. The CEO had some interesting comments, some very, if you were a long-term investor, some very encouraging comments, I would suggest. So his name is Sir Lucian Grange, which I thought was the
Oh,
poshest name I've ever
yes.
heard. You can imagine him with his monocle.
Yeah.
But Sir Lucian was pretty chill about the whole thing.
Yeah.
It's funny comparing Dexcom and UMG here because I don't know if Dexcom's management performed quite well on this call in terms of explaining the dip, whereas Sir
Mhm.
Lucian was just quite serene about the whole thing. I'd say he's quite serene about a lot of things with the name like Sir
Yeah. Sir
Lucian.
Lucian.
He sounds like an evil person from a Disney movie or something. The guy
He
the guy
sounds
trying
like,
to steal the orphan girl.
yeah, or like he sounds like he would be like the evil Mr. Peanut. They'd be like, Mr. Peanut's Wario is called Mr. Lucian.
Yeah. All right, but he has some good comments. I speak back because I don't know
Yeah.
what he's like. He speaks well, anyways. He said, throughout this journey of long-term growth, we know that quarterly fluctuations in one source of revenue or another are to
Mhm.
be expected. So while we report results quarterly, we manage the business for long-term success. We think in multi-year cycles and anticipate and embrace variations in certain business lines. That's something I would love to hear as a stock
Yeah.
as a shareholder in this company. Like, yeah, look, we'll have a bad day here and there, but over the long term, we know exactly what we're doing. We'll renegotiate a deal with Facebook. We'll figure that out. We've got a
Yeah.
better deal with TikTok now, so it hurt revenue this quarter, but it's going to be better moving forward. So yeah,
Yeah.
um, it overall a good quarter. This would be something now I would be more comfortable picking up a deal on than
Yeah.
Dexcom. Even
Yeah.
just those comments alone.
Because it does kind of show, I suppose it's that thing of number one, he can explain away the miss and performance, which is something completely reasonable. Like if I was a stockholder, I'd be like, yeah, I would rather that you hold out on TikTok for a single quarter to negotiate us a better deal. Particularly those deals can be really long. Most licensing agreements are 5 to 10 years long. So he's putting it on the line to be like, yeah, we'll have security then for the next decade. And then I just think it just shows a responsibility in someone who is thinking long term. And I remember looking at the trend reports for music last year, and it's expected that music is going to grow in value, particularly music that's been made by a person is going to grow in value as we produce even more video and there's more advertisement going on, and there's all this kind of stuff. And so it is definitely an interesting space to be in. And you'd like to say, oh yeah, the person who is leading up my stock in that space is doing so responsibly and obviously seems to have good contextual knowledge of the space. Is he of music? I mean, with the name like Sir Lucian, I'm imagining he was born and bred in the music industry.
I feel like he can play the cello left-handed or something. Uh,
Yeah,
yeah, he was very bullish on what you were saying there, the trends in music in general. He thinks that
yeah,
streaming from within developed countries as well, not even like faster growing
mm,
developing countries, but that there's a big opportunity for growth still. He was talking about, so Spotify kind of threatened, Spotify had a huge quarter this quarter as well. They kind of threatened the release of Spotify Extra Premium. I'm not sure if that's what it's going to be called, but a step above the current Spotify Premium subscription. And UMG kind of expanded on this a small bit. They figured out basically, if it's an extra, we'll say if there's 200 million Spotify premium subscribers, maybe
yeah,
20% go, that'll be 40 million. And then if the 40 million go and pay an extra €6 a month, we get X amount. I think it's crazy amount that they get on royalties from a Spotify
yeah,
contract. And like it was an extra 2 billion in revenue to UMG straight off the bat. Very back of the napkin maths. But it
yeah,
was interesting how you're talking about owning one company in this industry, and
hmm
it very much feels like Spotify kind of works for UMG in a way.
mm,
Do you know
yeah,
what I mean? Like, as in, it's just like, oh, I hope Spotify does really well because we get a cut of their money, essentially.
yeah.
Yeah.
I mean, you'd much rather be UMG than Spotify. Like Spotify is always going to have the issue of like can never ever turn profitability, and that is not an issue for UMG because they own the asset.
Yeah.
So it's almost like, oh, if you want to buy Spotify, don't buy Spotify, buy UMG. Like that would be
Yeah.
my thinking.
Maybe. I mean, Spotify's been doing really well recently in terms of upping prices and also offering new tiers.
Yeah.
It's boxing a lot more clever than it was, but it's always going to have that royalty issue, and those royalties
Yeah.
go directly into UMG's hands. But
Yeah, that's they can never make the Netflix turn where it'd be like, oh, it'll be fine because we're going to make our own stuff and we can
yeah,
increase profitability. Unless Spotify, I mean, that would really be a Hail Mary. Spotify could turn around and say, we're going to become a publishing house and we're going to manage artists. And you'd be like, wow, okay.
Yeah, that would be a big swing because, as we said, those three, the big three labels control
Yeah.
so much of the music industry. It would be a big decision to leave them, I imagine.
Yeah, definitely.
Yeah. Just aside from that, and not, I don't know how relevant, maybe it could be quite relevant actually in the long term to UMG, but they brought up that they're working on translations for classic songs. So
Okay.
essentially, there you'd use AI with the artist's permission and based off their I don't know discography and whatever else, and could translate songs to local languages and stuff, which sounds a bit weird, but I
Mm.
don't know. And maybe it's okay too. I think it's better than hearing like Drake sing Tiny Dancer or something. Like, it's all with the artist's permission, and it's just opening up their range to a bigger audience. So yeah.
Yeah, it kind of reminds me of when like American artists will sing in Spanish for like one song so they can get nominated for a Latin Grammy. That's kind of that's kind of what it reminds me of.
This is a bit of a tangent, but do you know the Tarzan soundtrack?
Yeah,
The
bop,
Phil
incredible.
Collins, incredible. Yeah, Phil Collins.
Yeah.
Well, he sang that in like 8 different languages. They're all on Spotify.
Wow.
Yeah, it's nuts. And it's really, really good. You can go like Tarzan soundtrack in Dutch or something. And it's
Wow.
like Phil Collins just fully singing it,
Just going for it.
just going for
Wow.
it. Yeah. So this would be that equivalent, but for like Taylor Swift's discography or whatever else.
I'm sure they're definitely gonna have to run a financial model on that because I do think with Taylor Swift, I think people who don't speak English still just listen to it in English. Because I listen to music in Spanish and I don't get half of it. And I'm like, yeah,
Yeah, that's the thing. I'm not sure if it's as big a deal as people think, like immediately if you translate U2's Beautiful Day to Philippines to
yeah.
the Philippines, like is that going to mean it's the biggest song in the Philippines? I don't think so. But like
But
they
yeah,
do love karaoke over there. So
they
who
do.
knows?
All right. Fair enough.
Okay, we got through a lot there. I'm kind of wrecked
We
now
did.
talking about earnings
Yeah.
reports, but there were some interesting stories. Okay, Amory, thank you very much for joining me, and thanks everyone else for listening in. Remember, folks, we've got that offer going still for all our
Oh
podcast
yeah.
listeners. So Stock Club 20, you'll get 20% off all our products. That's Invest Plus, Horizon, Nexus, the Horizon Monthly, Horizon and Nexus bundle. Everything we have on offer, you can enter Stock Club 20 at checkout and you will get 20% off. That's it now. So we will talk to you next week.